The October rally in grain futures gives way to selling as November gets underway. Is this the seasonal slowdown we've been anticipating? Farmers make swift progress with harvest, but pockets of delays remain. What's the latest from the field? Crude oil prices plunge, but other input prices remain stubbornly strong. Where are costs headed as profit margins get squeezed? Senior editor Bob Bergdorfer joins me to discuss these stories and more on this edition of The Buzz. We noted the trend for futures to rally in October once initial harvest lows are made, but the gains last month far exceeded expectations. A squeeze on soybean meal appeared to trigger the burst as processors had trouble getting caught up with strong domestic and export demand after historically low old crop carryout at the end of the 2013 marketing year. Delays planting the soybean crop in Brazil prompted more buying because it will postpone the start of harvest this winter, shifting some late-season demand back to the U.S. The slow pace of harvest here in the States added to those concerns. Big speculators who entered the fall with a record bearish bet on soybeans were caught leaning the wrong way, and their short covering added further fuel to the fires. But a bull needs to be fed, as the saying goes, and traders started taking profits more aggressively after futures failed to take out multiple levels of chart resistance. Inability to rally Monday on news of a record week of export inspections appeared to seal the deal, at least in the short term. Bob, the news flow really shifts to South America this time of year. What's happening there with weather and politics?
Rain is falling in the dry areas of Brazil, particularly Mato Grosso, and that should help speed up soybean planting. Planting will still be late, which will push back the harvest, deeper into January and February, and that could help U.S. soybean exports for a few weeks during that time, as they won't have to compete with those soybeans. Recent quarterly earnings from both ADM and Bunge did show farmer selling in South America has affected their results for that region. The tight hold on crops there may be easing in Brazil. Soybeans, as you know, are priced in dollars, and with the dollar at a 4-year high, and the real being weak, farmers may be more willing to turn those crops loose and make it benefit on the foreign exchange. In Argentina, crops are still being used as a hedge against inflation down there, against that currency, although the government is pushing farmers to sell because it needs the tax revenue. So we might see some movement there.
Here in the U.S., farmers made better progress as October ended, with 83% of soybeans harvested, in line with the 5-year average. Corn harvest advanced to 65%, but fields in the north remain behind, with sloppy weather forecast for the next couple of weeks. The slow pace of harvest may have kept supplies from hitting the market all at once and overwhelming storage capacity. Basis, though weak, has tightened some in the country for corn, and the rally knocked 3 cents off December-July carry. Still, hedging corn on the rally was prudent because higher average prices in October mean most growers will get nothing from revenue protection crop insurance, even if they bought up high levels of coverage. Now the market looks forward to the next production supply and demand reports from USDA due November 10th. Some continue to see these big crops getting bigger. Bob, what do we expect from the government next week?
The USDA report, at least for U.S. crops, will probably confirm what we're hearing from farmers in that the corn and soybean yields have been pretty good. The harvest is progressing well with little or no crop losses due to the lateness of that process. Corn stocks are holding up well, as are bean plants. Farm Futures does expect slight increases in the corn and soybean average yields, corn at 174.9 and beans at 47.3. Those, of course, up a little bit from October. That would put production at 14.53 billion for corn, 4.523 billion for corn, and nearly 3.95 billion for soybeans. U.S. ending stocks for corn may slip a little at 2.07 billion, while soybeans may be unchanged and wheat up a little bit. Globally, we do expect some increases in ending stocks for corn and wheat, and minor slippage in the soybeans.
Grains aren't the only commodities under pressure. The strong dollar and concerns about global growth pressured gold and crude oil as well. The tumble in energy prices continued today, with crude making new 3-year lows as Saudi Arabia slashed its prices, trying to maintain market share against rising production in the U.S. But don't look for any bargains today in red diesel. Basis level in the cash market are some of the strongest levels on record, as much as 50 cents over futures. Midwest supplies are shrinking on farm demand, and more problems with refineries and pipelines in the region, disrupting supplies just when farmers need the fuel most. Fertilizer isn't any bargain either. Wholesale ammonia costs out of the Gulf and Black Sea shot up in November as international supplies remain tight due to production problems, including the closure of another plant here in the U.S. for maintenance. Urea prices are also starting to turn higher after big purchases by India and closure of the low-tax export window in China. Phosphate demand is soft, but prices aren't going down much, and potash remains firm. Bob, the transportation system is blamed for a lot of these troubles. Is it getting any better?
Seeing some improvements in the rail and barge movement for grains. Shipping rates have come down in recent weeks, but they're still high relative on a historical basis, rather. Soybeans have been the big story in the barge market, accounting for about 3/4 of the barge grain shipments to the Gulf during the latter half of October. That is consistent with our farmer reports, and that soybean harvest is ahead of corn in the Midwest, and that farmers are selling beans and while trying to store as much corn as they can. Rail rates have dropped sharply in recent weeks, as I've noted and pointed out, but are still high historically. Rail movement of grain in the latest week was okay, down slightly from a year ago. We are not hearing any hiccups at the moment in terms of delays in getting cars and backups and so forth. However, as you know, the harvest is early and we will have to be monitoring that in the months ahead.
Well, thanks, Bob. We'll be back soon with USDA's latest take on prices and acreage on the next edition of The Buzz.
We'll have to have more margin now, there isn't any doubt. So you better dash with a load of cash or we'll have to sell you out.